What's up, you guys? It's Paul here. In this video, I wanted to talk to you about a quick update on the stock market right now, whether we still might see a stock market crash or if we're about to go back up, seeing that we saw some good green days over this week so far. And on top of that, I want to share with you a new debit spread strategy that I'm working on for SPY, and also a really important thing for all option traders. There's a risk with trading spreads that I've learned about recently, and I wanted to make sure that all of you watching my videos are also made aware of it, okay? Now, the quick update for you here is, as I talked about in my previous video, when we saw this initial correction here, I was looking at the 50-day moving average as being a strong support. And if you look currently, this 50-day moving average is around $332. And I expected that we would be able to hit that and bounce back up and maybe retest it and go back up. But as you can see here, we didn't even test all the way down. We came only all the way down here. We bounced back up. And then we are still kind of trading horizontally or sideways for now. Now, this black line here is actually the previous high before the market crash we saw here, around $339, okay? So as you can see here, as it went back up, it barely crossed this line again, bounced off of it, came back down, and now we retested it. And now what we really have to watch for is if you're really going to see an upward movement from now at this point here or not, okay? Now, if it still does go back down again and retest the 50-day moving average, and if it still keeps going down, then we might be in danger a little bit. But these are the two different ranges that I'm watching right now, okay? Now, as of now, I'm looking at the futures here. The futures seem a little down as of 7:51 p.m. EST here, but not a whole lot. We still would have to see how it's going to look like tomorrow morning. And today we only saw a 0.5% move, but these are the two ranges that I'm watching, okay? The previous 52-week high around $339, $340, and the 50-day moving average, which is around $332 right now. As long as we stay above this, I think we'll still be in a good market, okay? Now, having said that, there is still a lot of uncertainty in the market with elections coming up. So, you know, for all we know, there could be a lot of volatility, mostly sideways trading. So just be careful. I'm not trading a whole lot of options. If I do, I'm only trading spreads because even if there's a premium crush with volatility or, not a lot of sideways movement, both the long and short positions will get crushed simultaneously. And that way, just depending on your strike prices, you might still come out okay? So that's what I wanted to share with you guys. Now, the strategy that I'm trying out, this is kind of an experiment on my end, and I thought I'd share with you guys if you want to try it as well. But the strategy here is to trade weekly debit spreads on SPY, where you choose the strike prices and the premium you pay for it in such a way that you could potentially make a 15 to 20% profit on a weekly basis, okay? Now, for example, just yesterday, actually, I got one of these 331 call debit spreads, and I paid $85 for it, okay? Now, the way debit spreads work is, as long as SPY stays above $331, the value of the spread would be $100, which would be a $15 profit, okay? Now, if you look at it from a percentage point of view, the $15 per 85 is about a 17% profit in 1 week. Okay, so what I'm trying to do really is to see if I can slowly scale this up, to see if this really is a feasible strategy to be able to make about 10 to 15 or maybe even 20% on a weekly basis on a really small amount, and see how long I can really do this and be able to get 15-20% return in a week, okay? Now, as you can see, I'm putting a very, very small amount because this is very, very risky and speculative. As soon as we see a correction like we did last week, and if SPY does fall below 330, then the spread will expire worthless. So it's still a little bit of a gamble at this point. But thought I'd try it out. Let's see how it goes. I can keep updating you guys every week, and I want to do this for 6 months to a year and see what kind of profits we rake up, okay? Now, I started doing this last week. So my first trade, when I tried it out, was actually on September 9th here, where I got this $329 and $330 call debit spread for $86. And my plan was if SPY stayed above 330 by September 16th, which is tomorrow, then I could sell this for a quick $14 profit, okay? Now, what exactly happened was by September 14th, the stock started, SPY started going back up. So instead of closing the debit spread, what I did was I actually bought back the 330 call that I sold, and then let the 329 call appreciate a little more, and then sold it for $1,115. Okay, so if you do the math behind it, I sold it for $1,115, subtract the $964 I paid to buy back the 330 call, and subtract my initial investment of $86. So instead of making a maximum profit of $14, I ended up making a $65 profit. Okay, so if you look at it from a percentage perspective, that's actually a 75.5% profit. Okay, so that the amounts are really small, but what I really want you to pay attention to is actually the percentages. Okay, so you could potentially keep doing this on a weekly basis, and even if you have a really small account and you're just starting out with $100, you could potentially start building this up and turn it into a bigger portfolio. Okay, now the risk that I wanted to share with you about trading debit spreads is that sometimes if the call that you sold is in the money, close to expiration, the person who bought the option from you has the right to exercise it. Now, what exercising means that they actually want to buy 100 shares of SPY at $329 from you, okay? Or in this case, $330, because that's the call that I sold. So what that means to say is, if you don't already have 100 shares, then you'll be forced to pay $33,000 to actually buy 100 shares of SPY to be able to sell it back to that person. Okay, so instead of having a maximum risk of $86, you could potentially be at a risk of $33,000 if you don't get a chance to exercise the call that you already bought. Okay, now the way to avoid this is, as you get close to expiration, if you made a decent profit, let's say you made this turned into $95. Instead of waiting all the way to 100, you could actually close out of this trade and just sell it off at 95 and avoid the risk of getting assigned. Okay, so this doesn't happen very often, really, but it's something that you have to keep in mind, especially close to expiration date, when your short position is in the money. Okay, so be careful with that. My suggestion is you could either close out the spread or just buy back your short position, and later on let your long position appreciate a little more and then sell it for a larger profit. Okay, so having said that, here's the 330-331 debit spread that I showed you earlier. Again, I tried this. I closed out of the previous position by September 14th and opened this one up expiring on September 21st because I want these to be weekly trades, and that's something similar to what that I'm going to do. I'll wait for a day where SPY might go down a little bit, and my plan is to maybe buy back the 331 call that I sold, and then let the 330 appreciate a little more later on by expiration, and sell that for a slightly larger profit. Okay, so if we could potentially make like this 15-20% profit on a weekly basis, I think that can really stack up. I don't know, and there is definitely a lot of risk involved because I'm only paying $85 right now, and eventually I might scale it up to $300, maybe $500 per spread. But if you're using a larger amount, say $5,000 to $10,000, expecting to make a 15-20% profit per week, understand that there is risk involved and that a quick correction can make you lose all of the money. Okay, so just be careful with this strategy. It's an experiment on my end. I want to track it and be able to show it to you guys to see that this is not as unrealistic as people might think. And I thought it might help you out if you want to actually try this challenge with very, very small amounts. Okay, so I hope that helped you guys. Be careful with that risk with spreads. Don't let your short position be in the money by expiration. If it is, close out before expiration so that you don't run the risk of being assigned. Okay, so that's all I wanted to share with you guys for today. I hope that helps you out. Please just smash the like button if you enjoyed it, and leave a comment below if you have any questions. Okay, and be sure to subscribe and hit the notification bell. And thank you for watching, and until next time.